let's now put everything together with this one great trading example on GBP USD, which was a trade that we took about last week on the 28th of April 2021, which we caught about a little over 8 hours. Okay, so putting everything together, firstly, we're going to start with the top-down analysis, right, to find a direction in the market. And then we're obviously going to scale down to our lower time frames to find the order flow, right? So find the intraday dealing range where the momentum is pointing at to play within that intraday range. Of course, we're going to identify liquidity and mitigation. So where is price likely to go if it hasn't tapped into certain points of liquidity, or if it has mitigated price inefficiency and whatnot. Then, of course, we're going to look at our Asia session range, right? Since we do trade from London to New York, we like to see sweeps below or above Asia session range, or above or below the dealing range. And then, of course, we're going to jump into the different entry types. And when we look for entries, we specifically look at our peak session timing, right? So around the pre-London Open to a few hours after the London Open. And then same thing with New York. So pre-New York Open all the way through to the New York Stock Exchange Open. So let's get started with the top-down analysis. We start on the weekly time frame, and just by looking at the most recent price action, okay, we have, of course, a weekly low and a weekly high where price impulse to break this previous market structure point, right? Whatever happened here is just substructure, right? Retracing this impulsive move to the upside. And we can see that if we measure this up move with our Fibonacci, we have price tapping into our favored fib zone, right, between the 61.8 and the 786. And of course, the 0.702 is simply the midpoint between these two fib points. So we clearly have price tapping into a discount price for potential buys and continuation to the upside to go with the overall trend since May 2020 for about last year, okay? And of course, I've identified this weekly order block where price tapped into about the equilibrium point. If we measure the equilibrium, okay, so price pushed to about the equilibrium point of this weekly order block here, where price pushed significantly to the downside, breaking, you know, this bullish structure to start bearish structure. And then, of course, as price started to print higher highs and higher lows, we came back to this area on the higher time frames and created a rejection. Now let's scale down to the daily time frame. Okay, we're going to take a better look or a closer look at this price action over here, where we can see price, you know, tapping into this weekly order block and then creating lower lows and lower highs, and potentially having, you know, a pool of liquidity above here and up below these areas. Okay, so we're going to go into details into that. So you see this is the marked up zone. Okay, and just by looking at this, we can clearly see that once we tapped into this weekly order block, we started shifting market structure to the downside, right? With first this break of structure, okay, this retracement, and then we failed to create another break of structure, and we pushed up to create a bullish break of structure. Since we have, you know, undecisive markets, right, a break of structure to the downside, then shortly after a break of structure to the upside, we can clearly see price is simply generating order flow for the next big move, right? Whether it's to the upside or to the downside, we just want to identify that we are in a zone, a consolidation zone, or an area where price is generating enough order flow for the next big move, and we want to position ourselves to catch either sides, right? Of course, we want to favor the overall structure on the higher time frames, and that will come with your positioning once you find a direction for the next big move. Okay, so we're looking at the daily time frame. We have a set or sets of equal highs here, meaning that we have liquidity above this area of course, a liquidity pool, and same thing goes with the lows here. So we have sell side liquidity from these equal lows, and of course a liquidity pool below. So we can see that within this favored fib zone that we were trading in on the weekly time frame, we came back and tapped into this daily order block, right? So this impulse on the weekly originated from here. However, the true momentum really kicked in from this daily structure low to this daily structure high, right? Breaking this point of structure. So price came back, gravitated all the way back to this order block, filling all price inefficiency within this price or area, and then created a reaction. Okay, so we could potentially start seeing, or this was the idea behind my analysis when we took the trade on the 28th of April, that we want to favor the upside, since on the higher time frames we have tapped into higher time frame points of interest, and we, in most recent price action, we started breaking structure to the upside for our daily time frame to point to the upside, right? So now we have a daily time frame pointing to the upside, as well as our weekly time frame pointing to the upside. So with this in mind, I had a directional bias, right, for the week or for the next couple of weeks to point to the upside. If we go back to the weekly, right, we have order flow pointing to the upside. So the previous 2 weeks we had bullish momentum, right, a bullish weekly candle closure, and the week before this week here was a bullish candle as well, right? So we have 1, 2, and 3 weekly bullish candles pointing to the upside once we tapped into this, point of interest. And we know that in this area here we have a daily order block where price came back to fill those original orders that remained within this big impulse to the upside. Okay, now that we have that set in stones, right? So we have our higher time frames pointing in the same direction. We want to also point out that within this impulsive move to the upside, right, where was the price inefficiency? Was there any price inefficiency left? There was, right? So if we look at this wick over here, and of course the close of this candle, we had this whole area for price to gravitate back to fill the inefficiency, right, to mitigate this point, to then continue to the upside. Because if we look any lower than this area, we have extremely efficient pricing, right? There's no skips in liquidity here. There's no reason for price, if it wants to continue to the upside, to go any lower or significantly lower than this price point here. Okay, so let's scale down to the lower time frames, the intraday time frames, to see where we're at over here. Okay, so the 4-hour time frame, we see a little bit more details on the consolidation box that we're in and the most recent price action and breaks of structure to the upside, right? So we can clearly see that within this impulsive move to the upside, we have our point of origin down here, the highs that was created at the equal highs, and then price gravitated back to mitigate this daily imbalance, right? Tapped into this 4-hour order block, and then moved to the upside, creating a sequence of higher highs and higher lows. Okay, so that is telling us that potentially we can continue with this bullish order flow, right? Now let's jump to the 1-hour time frame. Okay, we have our session breaks or daily session breaks. We have this new week that started here. Okay, we didn't take a trade on Tuesday. We're gonna skip a few candles to see how price was developing for Wednesday, and then we're gonna jump into all the boxes that were ticked and the reasons for us to take the trade that we took. Okay, so if we skip candles here, we can see Tuesday's closing. Okay, it was more of a ranging market. And what can we see from Monday to Tuesday, right? We are looking for overall up move, since we've reacted from this 4-hour order block, mitigated the daily imbalance, and we started printing, from this low, a higher high, higher low, higher high, and higher lows, right? So what we were expecting is a higher high to be created and to continue with, obviously, this beautiful theoretical higher high and higher lows image. However, in reality, it won't look exactly like this, but this is what we're looking for upward movements. Okay, so before taking a trade in Wednesday, of course, we would wait for Asia session to form. Okay, so this is pre-Asia session. Let's go back just before. So here we go. So this is Asia session. So when we wake up for the London session, we want to take a look at our chart and what it has done in the previous day and currently in the Asia session. So what I saw here is on Monday we had created, right, sell side liquidity here with equal lows, okay? And on Tuesday we had seen a sweep of that liquidity, right, a drawn liquidity below the Monday lows to create that lower wick on Monday, for the week, sorry, and then bullish momentum, okay? So let's identify this as sell side liquidity, and of course this was a draw on liquidity where price spiked below the previous daily low and then impulse to the upside. And we're gonna pay attention to the timing of this sweep, right, for that upside move. Now, since our example is for Wednesday trade, we're just gonna summarize quickly what has happened here. There was a trade opportunity. Okay, so this was a drawn liquidity below the previous daily low. Okay, so we clearly see the Monday dealing range was from these lows to these highs, where price kind of consolidated in, and then in the next day we had a sweep below the Asia session range and below the previous daily low, and then start pushing to the upside. So we go down to the 15 minutes just to pay attention to the session timing. Okay, let's come and draw these here. So we have our London peak session time from 2 a.m. to 5 a.m. This is, where's my London? London, I'm going to put this at the bottom, and then we're going to have New York from, excuse me, let's just do this from the start. So we have New York from 7 a.m. Eastern till 11 a.m. Eastern. This is New York. We'll put this to the bottom. Okay, so those are peak session times where we want to look for entries or for executions. So we have the sweep of the Asia lows here in the London Open. We created an impulse, it wasn't an impulse here, but consecutive bullish candles to the upside. But shortly after, price drew liquidity below the actual daily low and then started pushing to the upside, right? So the trade here would have been the buys after the drawn liquidity. There was somewhat of a setup here based on the breaker block over here. Okay, this is a breaker block, and the reason why this was a breaker block is because this was the point of origin for this impulse that broke the previous lows, and then of course these lows here where it tapped into the sell side liquidity, and then shortly after, price impulsively broke above it, and there was somewhat of price inefficiency in here, and we can see price came back and filled this inefficiency to the T. Okay, so we can go and identify this right here, where we had an imbalance, right? So price broke out, came back in New York session, and notice what time it is. So if you go see at the bottom over here, so 9:15 to 9:30, which is the New York Stock Exchange open, price came back to retest this breaker block, fill this inefficiency, and then move to the upside. Anyhow, what we want to focus on is on the Wednesday trade, okay? So given this information, we have our new dealing range from this low here, okay, which this would be an order block, okay, on the 15 minutes, since we did break above this point of structure. And this is a bullish break of structure, and of course we had another break of structure over here, so double break within this big impulsive move to the upside, right? If we go back to the 1 hour, apologies. We go back to the 1 hour, we can see this a little clearer, so we can clearly see break of structure here on the 1 hour time frame, and this is minus structure on the 1 hour. However, we know it's actual market structure on the 15 minutes. The order block on the 1 hour would be based on this candle here. We can refine it to here. However, we're just going to ignore the 1 hour block and just use the refined 15 minutes, since price already tapped in this 1 hour block in Asia session. So we'll keep it as it is right now with the 15 minutes. We're going to delete these little drawings since this was for Tuesday. And I want to copy these. Okay. Or I'll just move them here so we have both of our sessions that we're interested in. Okay, so as we approach the London Open, we could expect price, right? We look at our order block that we drew. We have some imbalance based off over here. Okay, this is imbalance. I'm not going to draw it like this. I have an imbalance zone, okay, where price is tapping into the imbalance. However, it hasn't fully mitigated that imbalance, right? So we have cause for price to move lower to fill this imbalance, right? So this is reason number one for price to move lower. Before moving up, we would like to see a sweep of liquidity. We have our Asia session lows right here, so it wouldn't make sense for price to sweep liquidity below these lows and then start printing bullish market structure, right? If we go down to a lower time frame to 15 minutes, we would have a set of equal lows here. Okay, let's say, for example, I go quickly onto the 1 minute. Okay, we have a sequence of lows here which identifies or tells us that we have a pool of liquidity in this imbalance area for price to fill and mitigate and then tap into this order block. Okay, so back to the 15 minutes. Here we are. We have our peak session times. Let's put them closer to the order block. Okay, and what we can do is skip a few candles. So now that we have the pre-London, right, 2 a.m., the London Open will be at 3 a.m., right? So we were expecting this sweep in liquidity. And then here we are. This is London Open. Okay, 3 o'clock. We can clearly see price sweeping these lows, the Asia below the Asia session range, mitigating completely this imbalance. So what we can do is identify this as mitigated. Okay, so I'm going to delete the imbalance, and it has been mitigated. Okay, So this would have been your first entry type, right? We're gonna go and cover the different entry types based on our directional bias for the day. So clearly we're trading within this dealing range here, the lows here and the highs, and we're coming back to this point of origin. So this would have been your first entry type, the risk entry. Of course, I like to have a 2-pip buffer. So this is a 12-pip stop loss. So 14-pip stop loss would have been enough. And then we would have aimed for ultimately the buy side liquidity up here. Okay, and we would round it up to a 139,500, which is a psychological price level. Okay, so slightly above the buy side liquidity. So we know that there's reason for price to move back up to this buy side liquidity, giving us about 5.67 times our risk. Okay, so I'm just going to leave this over here because there are different entry types, as you may know. So there's the risk entry, there's confirmation entry, and then we can have a confirmation of a confirmation entry, which I call a double confirmation entry. So let's go through these. Okay, if let's say you don't trade the London session, you wouldn't have had the opportunity to enter as you were watching the markets, but at the close of the Tuesday candle, right, we could have anticipated it and had our stop loss, our pending order set at this level here, at the proximal point of the order block around 138,700. Okay, if we went for the equilibrium point, it would have came slightly shy, but if you're rounding your entries, so this is 138,647, right? We could have had an entry point at 138,650. Let's see if this would have triggered. So 650, the entry. Stop loss remains the same, 8.5 pips in this case. And from the looks of it, we zoom in and we look at the details of this candle here. The lows was at 138,651. It would have missed our entry by just a pipette, okay? So let's go back to the original entry at the proximal point and not the equilibrium. And let's just keep continue and skipping candles. So me personally, I didn't take this trade. It was quite early for me. I just had waken up, and I don't like taking trades without going over my pairs and reading some of the news and whatnot. So we skip a few more candles. We see price pushing lower at the equilibrium point, right, in the early London session. So if you had an entry at the equilibrium point, this is when you would have been triggered, right? Increasing your risk to reward, of course, because your stop loss would have been smaller. Now, if we continue to print candles, we see most recent price action, we had an impulse to the downside down here, and now we have a new upside push, and we can go get a little bit more details here on the 5-minute. Okay, so by looking at more details here, so we have our highs, our lows for this push here, which sweep liquidity below the Asia session range, right? Shortly after, we created a new high and a new low, right? We look at details based on market type reading 1, okay? This did break structure to the downside. So this tells me that this was our previous highs, and in most recent price action, we had a bullish break of structure. So if we're looking for a confirmation entry, right, this here could have been a confirmation entry on the 5-minute, right? So you would draw your order block here, 5-minute order block. In my case, this was an order block that I considered. However, since I tried to refine it to a lower time frame to see if there was a lot of imbalance, and there was. So what I did is I measured this box here, and I wanted to enter on the equilibrium point, and it was a miss. So price tapped into this 5-minute order block and moved up and broke structure to the upside, right? So to me, this was just a void trade where it was just a miss. But if you did put your order at the proximal point here, you would have been tagged into this trade. Your stops would have been below these lows with a buffer, or if you were a little bit more conservative, you would have your stop loss below the actual 15-minute block, respecting this risk entry stop loss, right? So we had an entry first over here, and then we refined it with a confirmation entry slightly lower, giving us a better risk to reward, right? So let's copy this. This is your first confirmation entry. Okay, we can go aggressive. So 6.5 pips. So we have 8.5 pip stop loss, and of course, same targets all the way up to the buy side liquidity at 139,500. Okay, so with the confirmation entry, we in the refined entry and stop loss, we would have a 9.54 risk to reward setup. Okay, now believe it or not, I thought that I missed the trade for London, which was most likely the case. Okay, however, by looking at the most recent impulse here, I thought maybe, okay, we could impulse to the upside and then come back to mitigate the imbalance that's being created within this impulse, and then enter around the New York Stock Exchange or the New York Open to really ride this trade to the upside. And our first points of interest would have been, of course, these highs, then the Asia highs, the previous daily highs, and then of course the weekly high, and then the buy side liquidity, right? So we'll leave those up here. So we factor in those points of structure as we are managing our trade. Okay, so price moves up, creates a massive impulse to the upside, right? And respects these highs here. So what we can see here, if we refine or go to the lowest time frames, the lowest time frame we have, we can clearly see this move as an impulsive move, breaking structure once again to the upside. Okay, and what we can anticipate is price to come back, right, to this 1 minute order block, or come back to this 1 minute order block where the point of origin lies, right, where there's still imbalance that remains there. Okay, now me personally, I would much rather use extreme points when I look at the 1 minute time frame, and I understand that we did tap into this 5 minute order block. However, we failed to mitigate all of the imbalance here in price for price to completely mitigate all this inefficiency in price for price to move higher, right? So I simply ignored this order block here, and I simply waited for price to tap into this 1 minute block for execution. Okay, which is at the proximal, equilibrium point of this 5 minute, and I rounded my entry at 138,660. Okay, so let's draw it there. 660, 139, 500, and then our stop loss, okay, would be equivalent to this here, which is, well, at the lows of the 5 minute order block is 3.5 pips. Okay, we would have 5.5 pips for an aggressive entry. Okay, however, I wanted to be a little bit safer. I didn't want to be too greedy. This would have presented a 15.27 risk to reward setup. However, I ended up using the 15-minute low at 7.5 pips, and I believe I just rounded my stop loss for 10 pips. Sorry, this is 10 pipettes. So 10 pips and a 1% risk on a $100,000 account with my FTMO would be just a rounded 10 lots. Okay, so this was my actual entry. However, let's go and draw the refined entry as well, just because based on the theory and everything we've learned, these lows should be respected, right? With a little buffer. And then of course the profit 139,500. So we have first, we go back to the 5 minutes. We first have here our risk entry. Okay. Second, we have here confirmation entry. And then of course, these two entries over here would be a double confirmation entry where we have a confirmation of a confirmation entry. So let's go ahead and extend this order block and this 1 minute order block as well. Of course, the 1 minute order block, we would want to factor in the lows as well. Okay, so there we go. Skip candles. So there's still price inefficiency down here. We are somewhat in a dead zone, you know, in between the London session and the New York. So we could see price arranging in that area. Quickly sweeping the highs above here. And then eventually, as we approach the New York session time, this is where we're interested in taking an order, right? So you see price comes back down, triggers our entry, okay? Whether it's the aggressive or the more conservative one, which is the one I went for, okay? You keep skipping candles. So this is New York, 7 o'clock Eastern time, so pre-New York, okay? Price pushes down, comes extremely close to this tight stop loss, as well as to the stop loss of this confirmation entry. Now, if I was in this trade here, most likely as we broke out of this high here, I would have mitigated the risk. Okay, would have taken some partials out and ultimately closed that break even. With the risk entry, about maybe the same story there. However, with the confirmation entry, this would have been your actual entry and we could have continued with the upside. So we incurred some drawdown, and then 7:30, okay, and as soon as New York session opens, right here, New York session opens, we're swimming in profits right now. Whether it was our original entry or the more aggressive entry. And then you can see that price can, once mitigated all of this price inefficiency, sweep the lows one last time, we continued to the upside. So within this impulsive move to the upside, breaking this price point here, okay, let's identify it, and this is how we would be monitoring our trade, right? So we have a break of structure, bullish minor break of structure, but if we go to the 1 minute, it's actual price point, actual price action, right? So we have price inefficiency in here, price coming back, mitigating this once again, right? So this could have been a triple confirmation entry based off of this order block and price moving up, right? So you see how fractal the markets or the price is, right? And here we go. This approaches New York Stock Exchange open. And by the time the New York Stock Exchange opens, which is right here, we see price making a new breakout structure to the upside, and this is where I personally mitigated my risk, and you could have mitigated your risk up here once again. So there's no more risk on the table. We're running about, excuse me, 33 pips off either a 5.5 pip stop loss or a 10 pip stop loss. So about 6 times or 3 times our risk. And we've already tapped into this first point of interest. We're approaching the Asia highs. Okay, and then we knew that around the 2 p.m. mark, let's identify this, we had economic news. So the Fed was releasing interest rates and a statement. So we knew that there was somewhat of a manipulative move that was going to happen around the 2 p.m. Eastern time mark. Let's put a vertical line. 2 p.m. So as price was moving to the upside, right, we knew that once we approached the 2 p.m. mark, let's go to the 15 minutes to make this a little quicker. Once we approach the 2 p.m. mark, we could expect to see somewhat of a manipulative move and then continue to the upside potentially, right? So before doing that, we know that this impulse here to the downside, right, broke structure here on the 5-minute, okay? So we broke slightly structure, some structure to the downside, so we have a breaker block right here, okay? I'm going to draw it on the 15 minutes for it to be much clearer. So we have the lows of this candle here and the highs of this candle. Okay, and I want you to notice that there is imbalance right here. So we could expect, if we have a manipulative move from the news, right, we have a little consolidation area here. If we sweep liquidity at the news release, we could expect this to be a draw on liquidity and a move higher to then target our highs, right? But at this point, we weren't looking to scale into our position. However, it was an option. And if you didn't take any of these trades, this could have been an option for you to execute on, okay? So we skip candles. Here we go. So we clearly get that manipulative move on the news release, 2 a.m. We fill this imbalance that lied within this order block, okay? So if we had an entry within this area, could have been at the proximal point, the equilibrium point, or somewhere in this imbalance, right? Let's say it was the imbalance and your stops below with a little buffer. So 6, let's do 8.5 pips. And then of course you would aim first for the highs, since we do have equal highs at this point and we know there's liquidity above it. Okay, we have equal highs here. So reason for price to move higher. This would have been a 3.65 risk to reward. And of course, all the way up to the buy side liquidity, 139,500 for a total of 6.82. And here we go. This was pretty much the end of the trade. So multiple entry opportunities, a few other opportunities to scale into this trade. We factored in economical news event, right? We know that around the release there is manipulative move where price will seek liquidity, right? We've identified a point of interest within this breaker block. We've identified imbalance in price where price can go and mitigate to continue. Our entry here lined up with all of our peak session timing, right? So we had a risk entry and a confirmation entry in the London session. Depending on how you managed your trade, you would have either taken partials or only been taken out at break even, or simply just waited for the day to kind of print out and your stop loss would have remained below this 15-minute order block, right? Price never spiked below the point of origin of this dealing range, right? The previous daily low and the previous daily high. Okay, this was the dealing range we were dealing in for Wednesday. And then as price moved up, we had an opportunity to scale in and continuation. So a total of, me personally, I took 8 plus 8R. So I exited the trade slightly before the 139.500, giving me 8 times my risk. However, if you used the more aggressive stop loss here, we would have had a 15.29 risk to reward. And of course, the scaling position yielding you 6.82 R. So if you're risking 1% per trade, this is 6.82%, or 8% on the 8R, or 15% on the 15R. So this pretty much sums up the lesson on how to put everything together. So just to sum everything up, we started with a top-down analysis on the weekly time frame to find a directional bias for the week or for the next couple of weeks, and it was to the upside, right? In our top-down analysis, we went and analyzed the daily time frame, and we noticed that we were in some accumulation or distribution consolidation zone where price is bound to make a breakout to the upside or to the downside, and if it does, it would target, you know, the daily structure high or the daily structure low. We go to the 1 hour here, so we have the 140 mark, and then we had, of course, the lows of the consolidation and the equal lows here at the daily structure low around 136,700. Okay, then the next thing we did, we went down to the intraday time frames and we went and identified the order flow. We went and found our dealing range, right? So we found intraday dealing range and where or what direction the momentum was pointing at, and it was clearly to the upside with all these impulses that we had, leaving imbalance when price was moving to the upside. Then we identified, of course, our order blocks, since it is the framework for our entries and exits. Okay, we used a refined order block on the 15 minutes, which was at the point of origin of our dealing range. Okay, we identified liquidity, right? At this buy side liquidity. We've identified cause and mitigation, so cause for price to move lower to tap into this 15-minute block. We used the concept of the Asia session lows, or the Asia session range in general, where the pre-London or London open, right, tends to sweep liquidity below these points to mitigate whatever price inefficiency lies below it. And of course, we had additional points of confluence for that order block to be a higher probability trade setup. And then it came down to whatever entry type you're most comfortable using. And if it was, whether it was the risk entry, confirmation entry, right, double confirmation, or the triple confirmation, this all just showed you how fractal price is, and what you do on one time frame can be done on another time frame, no matter your style, right? So you can specialize on the lower time frames as long as you're supporting your lower time frame entries with a higher time frame analysis. Okay. And of course, we showcase the importance of the peak session times, right? So we want to filter out per se entry signals if they don't line up with our peak session times. Okay, so thanks for watching, guys, and this pretty much sums up all of the concepts we've seen in one simple trade. Of course, this is like a holy grail of a trade, yielding, you know, between 8 to 15 times your risk and if you added a scaling position to that, you added an extra 6%, so you could have yielded up to 20% in one trade. And this just shows and backs my saying every time I say that less is more, right? Look for high quality trade setups and try to avoid and filter out the lower probability ones, okay? So one trade could set you up for the week and for even multiple weeks. It could do your whole month. So imagine making 15% on a FDMO account with $100,000, right? This is a $15,000. So the median salary, right, for Canadians, for someone like me, right, we have monthly, I believe it's like $3,000, right, for a median salary of about 50 to 60K. So regardless, thanks for watching, guys, and we'll see you on the next video. Bye.